Welcome to the story of Bintang Glove SDN, BHD, a family-run Malaysian rubber glove manufacturer on the brink of transformation. With a consolidated turnover of RM250 million and nearly 1,000 employees, Bintang is preparing for an initial public offering at Bursa Malaysia. This move marks a significant milestone but also brings new challenges. The company recently acquired a ceramics forms supplier, expanding its reach through vertical integration. However, this growth has introduced complexities from culture clashes to regulatory hurdles. In this video, we'll explore Bintang's journey through risk management, stakeholder conflicts, and the path to sustainable governance. Bintang Glove's ambition to go public is driven by the desire to access new capital and expand in overseas markets. But IPO readiness is more than just financial performance. It requires robust governance, transparent reporting, and a comprehensive risk management system. The board of directors recognizes this, requesting a feasibility study and risk analysis to present at the next annual general meeting. This step is crucial for building investor confidence and ensuring that the company meets the stringent requirements of Bursa Malaysia. The journey to IPO is as much about internal transformation as it is about external opportunity. Bintang's organizational structure reflects its family roots. The executive team includes a CEO who also chairs the board, a CFO, COO, and a company secretary. 3 independent non-executive directors (INEDs) provide oversight, with Mrs. Hafiza Bintang chairing the audit committee. However, many supervisory roles are still filled by family members, and statutory reporting remains minimal. This structure, while fostering trust and loyalty, can also lead to governance challenges, especially as the company prepares for public scrutiny. The recent merger with the ceramics supplier has added further complexity, highlighting the need for professional management and clear lines of responsibility. Acquisition of the ceramics forms supplier brought new opportunities, but also significant challenges. Culture clashes between Bintang and ceramics employees have led to conflicts and increased staff turnover. The HR department, led by Ms. Jacqueline O. Yang, reports a rising fluctuation rate, signaling dissatisfaction and uncertainty. Health and safety issues in the ceramics subsidiary further complicate matters, exposing the group to regulatory risks. These challenges underscore the importance of integrating risk management and harmonizing organizational cultures to ensure a smooth transition and sustainable growth. Recent external audit highlighted major risks in Bintang's administration. The audit pointed to deficiencies in segregation of duties and a lack of internal control systems. Despite these findings, the auditor issued an unmodified opinion, raising concerns about auditor independence, especially given their 4-year relationship with Bintang and provision of non-audit services. These issues are critical as the company moves toward an IPO where transparency and robust internal controls are non-negotiable. Addressing these gaps is essential for building trust with prospective investors and regulators. Stakeholder conflicts are inevitable in any organization, especially one undergoing rapid change. At Bintang, different groups have varying objectives. Shareholders seek returns, creditors want security, employees prioritize safety and job security, and customers demand reliable products. The recent merger and IPO plans have intensified these conflicts, making effective risk management even more crucial. Understanding and addressing these diverse interests is key to protecting and creating value for all stakeholders. One of the most significant conflicts at Bintang is between the founding family and prospective IPO shareholders. Family members currently dominate supervisory roles, with minimal reporting requirements. However, IPO shareholders will demand transparent governance, independent oversight, and professional management. The family may resist dilution of control and increased scrutiny, while investors expect robust risk management and consistent return. Balancing these interests is a delicate task that requires clear governance structures and open communication. Another key conflict arises between creditors and shareholders, especially after the IPO. With a high gearing ratio, creditors are focused on the security of their loans and timely repayment. Shareholders, on the other hand, may push for aggressive expansion, which could require additional debt. This tension between risk appetite and financial prudence must be managed carefully to ensure the company's long-term stability and access to capital. Merger has brought together employees from different organizational cultures, leading to friction and uncertainty. Ceramics employees face health and safety issues, while staff fluctuation rates have increased across the group. Employees invest their time and skills in the organization and expect safe working conditions and job security. Addressing these concerns is vital for maintaining morale, reducing turnover, and ensuring a productive workforce. Management's desire for operational flexibility often clashes with regulatory requirements. Bintang's minimal statutory reporting and health and safety deficiencies in the ceramics subsidiary expose the company to regulatory risks. Bursa Malaysia's listing requirements demand comprehensive governance frameworks and transparent disclosures. Navigating these regulatory expectations is essential for a successful IPO and ongoing compliance. Relationship between Bintang and its external auditor raises questions about independence. The auditor has worked with Bintang for 4 years and provides non-audit services, yet issued an unmodified opinion despite control deficiencies. This situation creates information asymmetry, where insiders have better knowledge than prospective investors. Ensuring auditor independence is crucial for reliable financial reporting and investor trust. Dependent non-executive directors, INEDs, are meant to provide unbiased oversight. However, at Bintang, some INEDs have family connections, raising doubts about their true independence. Effective governance requires that INEDs can protect minority shareholder interests without undue influence from dominant family shareholders. Strengthening board independence is a key step toward meeting IPO governance standards. manage conflicts effectively, Bintang uses a stakeholder mapping matrix. This tool categorizes stakeholders based on their power and interest. Key players like family owners, institutional investors, major creditors, and Bursa Malaysia require active engagement. Regulators and rating agencies should be kept informed, while employees, customers, and suppliers need regular communication. Understanding where each group fits helps tailor strategies to manage expectations and reduce friction. Mediate conflicts between the family and IPO shareholders. Bintang can implement a phased transition to professional management, establish a family governance charter, and create transparent succession planning policies. Adopting the Malaysian Code on Corporate Governance and forming a family council to address internal concerns separately from board matters are also recommended. These steps help balance family interests with the demands of new investors. Managing the interests of creditors and shareholders involves establishing clear debt covenants, implementing cash flow forecasting, and creating a balanced dividend policy. Regular communication with creditors and setting gearing ratio targets aligned with industry benchmarks are also essential. These actions help ensure financial stability while supporting growth ambitions. Successful integration of employees from both Bintang and Ceramics requires a cultural assessment and harmonization program. Unified HR policies, joint employee committees, and retention incentives for key personnel are vital. Addressing health and safety issues in the Ceramics subsidiary and communicating merger benefits clearly can help reduce staff turnover and build a cohesive workforce. Appointing a dedicated compliance officer, conducting a gap analysis against Bursa Malaysia requirements, and remediating health and safety deficiencies are key steps for regulatory compliance. Implementing an internal control framework and establishing a regulatory liaison function further strengthen Bintang's compliance posture, reducing the risk of regulatory penalties and supporting IPO success. To address auditor independence concerns, Bintang should consider auditor rotation, separate audit from non-audit services, and establish policies on auditor independence. Implementing cooling-off periods for auditor personnel joining the company can further enhance trust in financial reporting and reassure prospective investors. Reviewing the composition of INEDs, appointing truly independent directors, and establishing a formal nomination process are crucial for board effectiveness. Regular board reviews ensure that INEDs can provide unbiased oversight, protecting minority shareholder interests and meeting governance standards required for listing. Dedicated governance, risk, and compliance (GRC) department is essential for Bintang's IPO journey. The recommended structure includes a Chief Risk and Compliance Officer (CRCO), Risk Manager, Compliance Manager, Governance Officer, and GRC analysts. The CRCO reports directly to the board via the Audit Committee, ensuring independent oversight and integration of risk management into strategic planning. Chief Risk and Compliance Officer leads the GRC function, developing and maintaining the enterprise risk management framework aligned with ISO 31000. The CRCO reports on risk profiles, oversees regulatory compliance, champions risk culture, and coordinates with auditors. This role is pivotal in preparing for IPO due diligence and ensuring the organization's risk management is robust and effective. Risk Manager conducts enterprise-wide risk assessments, maintains the risk register, and supports business continuity planning. The Compliance Manager ensures adherence to Bursa Malaysia requirements, manages health and safety compliance, and develops compliance policies. Together, they form the backbone of Bintang's risk and compliance efforts, supporting both operational and strategic objectives. Governance Officer supports board meetings, maintains governance documentation, and oversees shareholder relations. GRC analysts provide analytical and administrative support, preparing reports, maintaining documentation, and tracking regulatory changes. These roles ensure that governance processes run smoothly and that the organization stays ahead of compliance requirements. Effective governance oversight is achieved through a committee structure that includes a board risk committee, management risk committee, compliance committee, and audit committee. Each committee has a specific focus, from strategic risk oversight to regulatory compliance monitoring. This structure ensures that risk management and compliance are embedded at every level of the organization. Implementing a GRC department involves significant costs, including personnel, software training, consultancy, and office setup. In the first year, total costs are estimated at Rm 193 million, or about 0.77% of turnover. Ongoing annual costs are projected at Rm 1415 million. While these investments are substantial, they are justified by the benefits of improved governance, reduced risk, and enhanced investor confidence. Despite its benefits, the GRC function faces limitations. Family resistance to formal governance, reporting line conflicts, and resource constraints can hinder implementation. Operational challenges include integrating different systems and cultures and a shortage of qualified professionals. Over-bureaucratization may slow decision-making, while measuring the return on investment in risk management remains difficult. Addressing these limitations requires strong leadership and a phased, risk-based approach. Investing in GRC is justified by several factors. Bursa Malaysia listing requires robust governance and risk management. The cost of a single mayor incident could far exceed the annual GRC budget. Better governance reduces the cost of capital, improves operational efficiency, and creates value for all stakeholders. Ultimately, effective risk management is not just a regulatory requirement, but a strategic advantage. International standards provide a framework for evaluating and improving risk management. Key standards include ISO 31000 for risk management, COSO for integrating risk with strategy, and ISO 19600 for compliance management. These frameworks are recognized globally and help organizations like Bintang align with best practices, especially when expanding into new markets. ISO 31000, 2018 is a universal risk management standard applicable to organizations of all sizes. It emphasizes principles like integration, structured approach, and continual improvement. For Bintang, ISO 31000 provides a flexible framework that can be adapted to its family business context while meeting IPO requirements. Supporting standards like ISO Guide 73 and IEC 31010 offer additional guidance for risk assessment and treatment. COSO Enterprise Risk Management Framework is particularly relevant for integrating risk management with strategic planning and performance. It covers governance, strategy, risk identification, and reporting. For Bintang, COSO supports the feasibility study for overseas expansion and strengthens board oversight, making it a valuable supplement to ISO 31000. ISO 19600-2014 provides guidance on compliance management systems, including leadership commitment, policy development, and operational control. For Bintang, the standard addresses audit findings on internal control deficiencies and supports systematic management of health and safety compliance, especially in the ceramic subsidiary. It also lays the foundation for international compliance as the company expands. In addition to international frameworks, Bintang must comply with the Malaysian Code on Corporate Governance (MCCG), G20 OECD principles, and ISO 45001 for occupational health and safety. These standards are essential for Bursa Malaysia listing, attracting international investors, and addressing specific operational risks in the ceramic subsidiary. In Bintang's unique context, a hybrid approach is recommended. ISO 31000 serves as the primary framework, supplemented by COSO for strategic integration, ISO 19600 for compliance, MCCG for governance, and ISO 45001 for health and safety. This flexible, principles-based approach allows Bintang to adapt to changing circumstances and focus resources on the highest impact risk. Implementation of the risk management framework is divided into 4 phases: foundation, implementation, strategic integration, and optimization. Each phase focuses on specific standards and objectives, from establishing governance structures and compliance remediation to integrating risk with strategy and pursuing continuous improvement. This phased approach ensures a smooth transition and sustainable results. Principles-based regulatory approach is recommended for Bintang. This method offers flexibility, allowing the company to adapt to dynamic business environments and overseas expansion. It avoids over-bureaucratization and supports the entrepreneurial culture of the family business while focusing on risk-based prioritization to allocate resources effectively. Cash flow stability is fundamental to Bintang's financial health. Fluctuations can disrupt operations, limit investment opportunities, and increase borrowing costs. A high gearing ratio and reliance on IPO proceeds make stable cash flows even more critical. Effective risk management must address these financial risks to ensure the company's long-term viability. Stable cash flows are essential for servicing debt and maintaining creditor confidence. Creditors assess repayment ability through cash flow coverage ratios. Volatile cash flows increase perceived credit risk, potentially leading to higher borrowing costs or covenant breaches. Ensuring predictable cash generation is crucial for financial stability and access to capital. Overseas expansion and other growth initiatives require significant investment. Unstable cash flows may force Bintang to postpone profitable projects or rely on expensive external financing. Internal funding, supported by stable cash flows, is typically more cost-effective and allows the company to seize strategic opportunities ahead of competitors. Reliable cash flows support operational resilience by funding working capital, supplier payments, and employee salaries. They also provide a buffer against unexpected disruptions, such as those experienced in the ceramics subsidiary. Maintaining adequate cash reserves ensures the company can weather operational shocks and continue delivering value. Institutional investors scrutinize cash flow stability and predictability when evaluating IPO candidates. Volatile earnings can reduce IPO valuation multiples and deter investment. Bintang must demonstrate strong cash flow management in its prospectus and maintain consistent performance post-IPO to build investor confidence and support share price stability. Stable cash flows reduce the cost of equity capital and enable consistent dividend payments, building investor trust. They also minimize share price volatility, making Bintang a more attractive investment. Effective cash flow management is thus central to creating and preserving shareholder value over the long term. To enhance cash flow stability, Bintang should implement rolling cash flow forecasts, conduct monthly reviews, and develop early warning indicators for stress. Optimizing working capital, diversifying the customer base, and building recurring revenue streams are also recommended. These measures help ensure financial resilience and support strategic objectives. Effective cost management includes converting fixed costs to variable, implementing zero-based budgeting, and developing contingency plans. Optimizing the capital structure by targeting an optimal gearing ratio and refinancing debt can further enhance financial flexibility. Maintaining adequate cash reserves is also essential for operational continuity. Integrating risk management into cash flow planning involves identifying key risks, implementing insurance programs, and developing business continuity plans. Hedging strategies for commodity and currency exposures can further protect against major loss events. This holistic approach ensures that financial risks are managed proactively. For IPO and ongoing requirements, Bintang's management and board must provide going concern assurance. This involves formal assessments, cash flow projections, sensitivity analysis, and clear disclosure of uncertainties. Maintaining this assurance is vital for regulatory compliance, investor confidence, and long-term sustainability.